Well, we are thrilled to be here today. This is arguably our favorite event. It's the best event of our year where we get together the family, our alumni, our friends, our parents, and most importantly, the students. So we're thrilled everybody's here and we're excited about what we've got today. This is always a great event given the speakers that we've historically had, and this is no different this year. So we've been really fortunate to just have an incredible number of speakers. So we will start, of course, here momentarily with a panel titled Real Estate Repriced, Capital, Risk in the Next Cycle, featuring Nick Azrack of Baupost, Tyler Henritze of Town Lane, and moderated by Erin Dixon, Sterling Investors. And of course, we have Mark Ganzi here today. It's hard to think of a more relevant voice to speak to a world where real estate, infrastructure, and energy are no longer separate sectors, but are increasingly one integrated system. And he and I will have a good conversation, engage in a fireside chat titled Powering the Digital Economy, Data Centers, Energy, and the Future of Digital Infrastructure. So we should have a great event for us today. I want to first of all thank our sponsors here. Our first time event sponsor here, Lincoln. This is their first year doing it. Although it is their first year, Matt Nicholson, who has moved and has recently started there, I owe a significant debt of gratitude to him for always supporting us here at Georgetown as a loyal alum himself. And then the Sitex Group. After this, we're going to go back to Dahlgren. Hopefully it's going to be a little less hot. And the Sitex Group is going to support us on the cocktail hour here. So Brian Milberg co-founded that firm and is also a Georgetown alum. So if it's all right with you, I think we'll get the ball rolling. What do you say? All right, so everybody's got the virtual program here, and I don't necessarily read bios, but very quickly, because I'm proud of all of our panelists here. I'm going to start with Erin Dixon, partner at Sterling Investors, where she's the head of asset management and business development. She's also a member of Sterling's investment committee, and all of that's wonderful. But most importantly, she's a Georgetown Hoya. So we're glad she's here, and thank you for moderating this panel for us today, Erin. To Erin's left is Nick Azrack, college. I won't say Georgetown College. I've been told that's something I shouldn't do. But so we have Nick Azrack here, also a Georgetown Hoya, global head of real estate for Baupost. So did you guys ever think you'd be speaking on the stage at Gaston Hall? Never. Okay, I love that. And then we have obviously to Nick's left, Tyler Henritze, who is the founder and managing partner of Town Lane. And he is not a Hoya, but his entire analytical staff is Georgetown Hoya. So let's clap it up for those guys. So we're very appreciative of you guys being here. I'm going to turn it over to you. When we get to Q&A, I'm going to come back up here. For those that I think know, maybe there'll be a QR code. If you have questions throughout the course of this entire event, snap the QR code and you can enter your questions and I will read them off and we will get going. So Erin, it's over to you. Thank you.
Perfect. Thanks, Matt. And welcome everyone. As Matt said, I'm Erin Dixon and I'm thrilled to be back here on the Hilltop as a fellow Hoya alum and sitting here besides two distinguished investors in the real estate space today. So we'll spend the next 40 minutes or so examining Tyler and Nick's perspective on the real estate sector and where they've had conviction making investments in their respective opportunistic pools of capital. And then, as Matt said, we'll open it up to the audience for questions. So I want to dive right in and talk first about investment philosophy and strategy. You're both actively making investments from flexible pools of capital, but with different structural frameworks. I'd like to understand how your investment mandate informs how you focus within the real estate space and how you invest today. So I'll start first with you, Nick. You have a broad mandate at Baupost. So can you walk us through how the decision to invest $1 in real estate is evaluated against other asset classes that you can invest in?
Sure, happy to. Thanks again for having us. This has been great and good to be up here with Tyler. Just team company. So so Baupost, we run a multi-strategy pool of capital. So it's a go anywhere investment vehicle. It's perpetual in life. It's evergreen. We have the ability to recycle capital, and it can invest in really anything under the sun. So stocks, bonds, private equity, real estate, obviously, derivatives across asset classes and globally. So the question that we ask every day coming in as an investment team is, where do I find mispriced investments? Where do I find, thematic investments that are going to have real tailwinds to them? And that creativity sort of permeates through to everything else that we do. So in the specific context of real estate, which is an area that Baupost has been investing in really since, the late 80s, early 90s, actually, on a private basis, we're typically thinking about not only is this a good real estate investment, but is this a really good absolute investment? So we're looking for great risk-adjusted returns. We're looking for, good absolute returns, which are typically sort of mid-teens and higher type returns, whether it's equity or credit. And we're also thinking about, sort of why us? What is the catalyst here? Why is this a great opportunity? And why is this going to outperform over time, versus anything else that we can be doing with that incremental capital? And I think, from a very simplistic level, the way that we think about real estate is a massive asset class. It's, by almost any measure, one of the largest in the world, and it trades by appointment. It trades through relationships. And so just that in and of itself means there should be inefficiencies and there should be ways to, generate alpha over time. So the good news is we've had a lot of success doing that, and that's how we think about it.
Awesome. And we'll delve into some of those asset classes in more detail in a second. But first, Tyler, wanted to ask you, you founded Town Lane around high thematic conviction investing. You raised over $1 billion in what many would describe as a difficult fundraising environment. Can you walk us through your original pitch to investors and really what resonated most with them as they were thinking about where to put their capital?
Yeah. Thank you for having me. It's great to be here. I feel a little bit, I'm going to date myself. I feel a little bit like Al Pacino in the movie Son of a Woman. This is an amazing, amazing room, but happy to be here. Everybody over a certain age got that, but a lot of you didn't. When I was leaving Blackstone after 19 years, I was really nervous, really difficult fundraising environment. And I felt like I saw a world where most capital in real estate was aligning around very specific single sector sharpshooters. And that wasn't what I was. A lot of my success at Blackstone the last 10 years that I was there, I had been leading the acquisitions business in the US, was really looking at big technological shifts that were happening in the broader economy, and then trying to think ahead as to how those translated into changes in behavior that would impact different real estate asset classes. And so we got into industrial in a big way in 2011 and 12, sort of trying to get ahead of e-commerce. I helped get us into the data center business initially by buying some power shells, trying to get ahead of trends we saw there, et cetera, et cetera. And so when I left and I was thinking about the business that I wanted to start, I felt like I had the worst fundraising pitch possible, which was essentially let me continue to do that with our team, looking at how the world is evolving and changing. And I had a lot of conviction that need to be able to pivot was going to be really important, because I saw a world where change was actually accelerating, not slowing down. We'd just been through COVID, where we had seen different asset classes spike and then come back down, and you were starting to see sort of this whole AI wave really accelerate. And so the first conversation I had with one of our largest anchor investors, I was sort of anxious about this and articulating this to a large endowment, and they said, you can't pitch to investors what you think they want to buy. You got to pitch what you believe in. And what I believed in when I was starting the business was having a business that could be relatively flexible, relatively nimble, be able to move quickly in a fast environment, not have so much capital that we had to paint with a really broad brush, but that we could be somewhat pinpointed. And I think that, combined with the fact that we were launching with a pretty good birthday, I left Blackstone when rates blew out, because my view was, in order to compete with the big existing firms, I needed some sort of an advantage. And I felt like that advantage would be a bit of disruption broadly in the marketplace. So I think the combination of having a good birthday, putting together a good team, and then, again, having a very flexible mandate that could allow us to be nimble in what I think is a pretty fast-moving environment seemed to resonate.
Awesome. And so I want to take a second and just talk a little bit more about the capital raising environment. And you touched on it briefly, Tyler, because you two have very different relationships with capital. Nick, real estate is just one sleeve, as we talked about within Baupost's Evergreen Fund, whereas Tyler, you raised a dedicated real estate fund. So two very different business models. So the question to both of you is, what does the LP fundraising environment for real estate look like today? Who's active, who's not, and how has that really changed over the last couple of years or decade?
Well, I would say the first thing I learned when we started a business is that not all capital thinks equally. You might think you've got a great team, you might have a great strategy, you might have great experience or track record that you bring to the table, but LPs are built very differently. They have different incentives, they have different mandates, and I think it was a lesson for me that there's a huge portion of available capital that doesn't care at all about a first-time fund manager. What they care about is tenure, they care about your brand, they care about the continuity of a team. And when you understand their incentives, it makes complete sense why they would think that way. So what we had to find was we had to find groups that were actually incentivized to be a bit entrepreneurial, to take risk, and to bet on a group early, because there is a lot of risk betting on a team that's early. And for us, that tended to be groups that leaned more endowment, foundation, and family offices. And I think fortunately, that group was starting to look at some of their existing relationships, and coming out of a world with higher interest rates, they were starting to rethink those. A lot of those groups tend to be incentivized to take a little bit more entrepreneurial risk, so they're willing to take a bet on an entrepreneurial firm. I think we realized pretty quickly that our success at going and knocking on the door of your state pension plan or sovereign wealth fund was going to be an uphill battle that we were not going to have a lot of success with, and so we didn't. That might evolve over time, but I think that was one of the big lessons learned. I think the other lessons learned was that the family office space has grown massively. I think it used to be, people thought about family offices as writing, $5 and $10 million checks. There's family offices that write $100 million checks pretty regularly. And that, fortunately for our sake, that pocket of real estate LP capital had grown, even as a first-time fund, us feeling boxed out by what at my old firm was the core bedrock of our investor base. That just was not really accessible to us as a new entrant.
And how do you get, just a quick follow-up question there, like how do you get in front of those groups? Like obviously you knew a lot of names from your Blackstone days, but for those new family offices, like how do you get in front of them?
So we had a strategy that we did not want to cold call anybody, and we didn't want to work with a placement agent, which meant a lot of work on our part. We wanted to try to figure out a way to daisy chain a series of warm introductions from people that knew us and knew our reputation, so that we went in the door with at least a warm intro. And so it was a lot of work. We were fortunate that first initial investor has a very good reputation in the endowment world. They made a couple of introductions. That next group, each of them made a couple of introductions, and it sort of daisy chained from there. And I think we actually tried to take a very different approach than what I think you see from some of the larger firms. I think we tried to take a little bit more of a quiet approach. We weren't particularly public about what we were doing. We did some things right out of the gate where we told investors exactly how much capital we were targeting to raise. It wasn't open-ended with some limit that I think was outsized for what we felt like we could do. And our view is we wanted to get in and we wanted to get out of market. We wanted to create a little bit of urgency and create a little bit of scarcity, which is really hard to do. And I think that worked for us. But in terms of getting in touch with people, it was, it started with, a half a dozen to a dozen relationships that we knew personally. And if, by a second or third meeting, we felt like a group was getting engaged with and liked what we were doing, we would ask them, is there anyone else that's like-minded that you would introduce us to? And if it was a head of real estate or a CIO, we would say we would love for you to connect us, and kept that going.
Awesome. Nick, can you tell us a little bit about your relationship with capital?
Yeah. I think the recent historic context is helpful here. So almost anybody who's investing as an LP in real estate today, whether it's public or private, it's usually for two reasons. Either one, because they have an allocation that's just been preset, either by a consultant or otherwise, or two, they're somewhat contrarian. When you look at just 10-year returns, 20-year returns for real estate versus every other asset class, whether it's private equity, venture capital, the S&P, private credit, real estate's a laggard by a couple hundred basis points, which can obviously turn into, over a decade, something like, one turn on your equity. So for anybody to be deploying incremental capital there today versus what they need to, there's usually some amount of, I think now is the time. And so what we're doing is we spend an awful lot of time talking with our clients who, again, are investing in, a master fund, and they're saying they love to see the fact that we are investing, comparing our best ideas versus our private equity teams, our credit teams, our equity teams, and why real estate, this real estate asset versus that distressed loan And that's a really healthy sort of ongoing debate. But also they need to, have a sort of a broader understanding that the wind is going to be at their backs. Because as everybody here knows, you can buy the best real estate deal, but if interest rates are going up a couple hundred basis points or capital's moving away from real estate, it's going to be really hard to hit the returns that you're underwriting. So I think there's a little bit of understanding the nature of who you're talking to. And I think a lot of things that Tyler hit on are right on, which is, referrals are your best friend in that business, and trying to keep it relatively close. You don't need 30, 50 investors. You need 5 to 10 really great ones who can stick with you. And candidly, that's how Baupost started. I mean, we started as a family office over 40 years ago, and it basically grew from there.
I'll say this, it's been interesting. I felt like at periods over the last couple of years, it has felt like real estate was a hardware business in a software world. And then in the last 3 or 4 months, it feels like we're in a hard asset business in a world where software companies can disappear overnight. It's been a tough pitch for real estate. Felt like it was getting a little bit easier January, February. I don't think the macro volatility has helped a lot, but it's an uphill battle today, raising capital for commercial real estate for a lot of reasons. And it's not, the historical returns. I think there's been a lot of overpromising and under-delivering. And I think, everybody's got their work cut out for them raising capital today in real estate, and the bar is high. You have to execute.
Yeah. Awesome. Now I want to dive into a couple asset classes where both of you have been active today. And we'll start first with office. Tyler, you acquired 440 South Church in Charlotte, which was 70% below replacement costs, mid-40s% occupied building. Nick, Baupost is backing RXR's Gemini Venture in Manhattan with assets like 590 Madison, 1211 6th Ave. So I want to understand what specifically gave each of you conviction to act now, and how differently are you underwriting office today in the current cycle versus how you might have underwritten it in the previous cycle?
Because I'll start. So obviously we're in a different world today for office than we were even a couple of years ago. I think there's 2 pieces to that. So everybody's worried about AI. I think we can all acknowledge it's probably over time not going to be great for office. At the same time, the degree of that nobody really knows. And I think to the extent that it creates the seismic change that a lot of people think it could, it's going to be bad for potentially a lot of real estate, be outside of just office. And you've seen that in some of the apartment retrading and potentially in industrial as well. So that's obviously just something that everybody's debating every day. I'm sure everybody in this room is thinking about. We have basically taken the view, and I think RXR's Gemini is a very good example of that, where 2 things need to be true. So one, we're purchasing or investing in assets where we can generate cash flow streams at something like a 10% yield plus or minus, 10% cap rate. And we're getting, 10 plus years of lease term, right? We may be buying something empty, but we ought to have extreme confidence that we're going to be able to generate those types of returns, which are obviously a huge shift versus what we were seeing, even a couple of years ago. And on that basis, if you have deep confidence that you're going to be able to get that, and so far theses have been true, who knows what happens at the end of those leases, but you're pretty confident that you're going to at least make money. And the question is just how much. So that's one piece. And the second piece, specifically in Gemini, it's a great example of this. We actually did that on a structured basis. So we came in with a, sort of bespoke financing solution to capital that needed to come up with a bunch of money fairly quickly. We structured something that we could speak for in significant dollars on a short timeline. We had a preferred return. We're very downside protected, and we share in the upside, to a pretty healthy level. So again, that was sort of something that I think Baupost is uniquely qualified to be able to do. It's one of the things we do a lot in our real estate book, and being able to have a large, stack of chips you can sort of push into a situation like that, we think just gives us real asymmetric upside.
And I'm curious, what could go wrong? Like, what does the downside case look like, in whether it's that deal or a different investment that?
There's a lot of them, obviously, and we debate this a lot. We started our sort of significant office investments sort of second half of 2024. And we started pretty slow. We were mostly buying distressed office out in Silicon Valley, where the thesis was very simple. It's highly diversified, employment based, a lot of intellectual capital, a lot of private capital, and huge amounts of gross absorption. The Silicon Valley market's basically the same size as the New York market, though a lot of people don't necessarily think about it that way. So there's just always deals to do from a leasing perspective there, even if the market's very vacant. So we felt confident that we could, attract absorption in that basis. So in that world, what we were really thinking about was, okay, what if everybody really does just want to work from home, and what does that look like? And, do we know that we can turn this into something else, whether it's housing or, R&D space or something like that, where people really do need to be there. So we were sort of debating that constantly. And I think what we saw over time was that you were seeing not only the types of tenants that you knew had to be back in the office coming and taking space, not for 2 or 3 years, but for 10 years, 15 years at historically low leases, but also they were looking at it and saying, Deloitte needs to take space here, and KPMG and my law firm, and all these firms that are sort of much more typical, generic office users. And I think at some level, we sort of looked at this and said, listen, we're not sure whether the office market's going to be 10% smaller than it was 15 years ago or 30% smaller over the next decade or so. But we feel confident that there was sort of the ability to lease space over time, which I think got us comfortable.
And Tyler, I mean, yeah, the office investments you've made have been more repositioning and lease up. So kind of walk us through your.
Yeah, I thought I was crazy myself when in a diversified fund. The first deal we did was we actually bought an office building in Atlanta called Proscenium in the summer of 2023. But it was born out of a conversation I was having with a former office owner who had gotten out of the business to get into the industrial business. The call was about the industrial market, and he was telling me how challenging it was to buy anything because he felt like all the underwriting assumptions were sort of, to the screws. And there wasn't a lot of room to outperform. And I just sort of casually said to him, are you seeing anything on the office side? And he brought up a situation. And to me, what I, as an investor, always try to keep an eye out for is inflection points. Because I think that's where you can make real money as an investor, when something changes demographically, technologically, sentiment-wise. And if you can get ahead of that, and be ahead of the perception. And the perception at that time was office was still, pretty dead. You were starting to see a little bit of green shoots in markets like New York City, but you certainly weren't in places like Atlanta. And we dug into the situation. We had a lot of unique insight into the building. We studied it intimately. And as we went through the underwriting, I looked at it and I said, so we can buy this, we can underwrite it on an unlevered basis. We can assume today's market rents and today's TIs, real market rents, not trend them. And if we can lease it up, and we felt like there were reasons we could, the building was probably the best location in all of Midtown Atlanta, right at the corner of 14th and Peachtree. Probably one of the only walkable locations in that submarket, catty corner from Colony Square. The prior owner, the building had been 90+% occupied for 15 years until the prior 18 months. We literally spoke to individual tenant rep brokers, and they told us, we want to be in this building. We actually want to renew, but we're not going to do it with the current owner. Current owner had promised a lobby renovation, then they pulled that back. Then they said they were going to refi it. And then 45 days before loan maturity, decided to sell the building. Guidance was $115 million. I said to our team, let's just bid it to an 18% unlevered return. And they came back to me and said, that's $80 million. So we bid $80 million. And the broker called me up and said, the guidance is 115 million, and we've got bids much higher than you. And I said, yeah, you've got bids from this operator, and this operator. I said, we've got cash. I said, you've also got a loan maturity in 30 days. Your lender's pissed off because they did you a favor during COVID. You didn't honor that favor, and they're not going to give you a day beyond your extension. And he said, can you get to $82 million? I said, yeah. And we bought the deal, and we underwrote it, stabilizing to a 12% unlevered yield on cost. We looked at where Cousins was trading at the time. We said, we have no idea what the right exit cap rate should be. Who knows? It's not a 5 cap. They were trading around a 7.5 cap at the time. We said, that feels like not a crazy exit assumption to believe in. And that's what we did. And we did a lobby renovation. We signed a big lease with KPMG. We did a big extension with a big law firm in the building. And it's been terrifying every minute of the way. I think the risk is that, these asset classes that go through these, kind of where people rethink them, the pain lingers and liquidity lingers. And there's still a real fear around office. I have no doubt that some not insignificant portion of demand is going to go away, but I feel very confident that whatever demand does exist is going to focus on the top 25% of buildings. And I think there's a huge bifurcation there, and I think there's a lot of money to be made. In general, when you have a bit of a contrarian view, you got to be nuanced. It gets down to block by block, corner to corner. Just before we bought this building, 3 or 4 months before, there was a trade down the street. It's a new building. Everything looked kind of similar, 3 blocks apart. Totally different opportunities. We had no interest in one. We liked this deal. It's just a very nuanced market. Being from Atlanta helped. Having a brother who was the leasing agent helped. So we had some good insights.
And so one quick question on capital, because capital, I mean, you know, your exit is one big question mark in office. Capital is another question, especially when you're going in on a renovation, unknown how big that can be. Like, how do you think about capital?
I saw this happen all the time. There's 100 different ways. If you want to win a real estate deal, the easiest thing to do is lie to yourself about what capital is needed. So in an office deal, if you want to get a deal through investment committee and not have anybody debate it, you monkey with the renewal probabilities. No one in investment committee talks about renewal probabilities. And I saw people do this all the time. They were trying to get a deal jockeyed to investment committee and they skinny down the capital that you need. And we were not going to make those mistakes. And so we loaded up, you know, what we thought the capital was going to be. We loaded up the TIs. We've actually ended up spending a little more than we underwrote, which is amazing, but we've gotten longer WALT deals done because we really wanted to create a bond-like asset, which, you know, thanks to Johnny, who's in the room, we're sort of on our way to doing so. But I think we try to be really honest with ourselves about liquidity, really honest with ourselves about real capital, didn't trend rents, and I think use an exit cap rate that I think hopefully is much more reflective of the asset class, which is it's a really, really capital intensive asset class. And our exit price per pound is 50% of today's replacement cost. So we said, you know what, that seems reasonable-ish to solve for an unlevered 18.
Yep. Awesome. I want to switch gears to senior housing, which is a space you've both invested in. And it's a sector with very powerful demographic tailwinds, but it also comes with very complex operating dynamics. So question to both of you is how you think about this investment opportunity right now and how you underwrite the risk premium that's involved in something with such operating complexities.
I think it's a great question. It's an asset class that got absolutely demolished going through COVID. But I think today, if there's any asset class that probably has the most demonstrable and measurable supply-demand imbalance, I think it has to be senior housing. You have, you know, unlike the multifamily space, you had supply cut off earlier because of COVID. And, you know, this silver tsunami that everybody's been talking about for a decade finally is here. I think this year is actually the first year that the baby boomer generation turns 80. I don't think that's a secret anymore. You know, we probably spent 9 months studying the space, trying to understand exactly how we wanted to play, taking some lessons learned from my prior firm. We really wanted to focus on newer quality, you know, new built assets. So a lot of what we've been buying has been from developers that built into the teeth of COVID. We're way behind schedule, way over cost, that have had difficulty essentially refinancing out their existing debt. They need to put in more equity. And we've come in and been able to buy those assets at reasonable discounts to replacement cost, at decent in-place yields, but with a lot of momentum. I think all of that operational complexity translates into operating leverage. That leverage right now is working in your favor. It worked against people during COVID. I think the biggest challenge right now in the space is just that the secret's out. Pricing has definitely moved a lot in the last year or two. And you have the public markets where you've got a couple competitors that have got a wild cost of capital advantage. So we've had some success buying kind of one-off assets off market. It's been a lot of work. It's been really hard. It's getting harder every day. The stuff that hits the market and gets marketed, we have a hard time competing. But I think it's a really interesting space. There's still no, you know, there's just beginning to be conversations about shovels in the ground. So I think there's actually a pretty decent runway here for a few years, and we'd love to do more. It's just a matter of finding opportunities that work for our cost of capital.
I'd add two things. I agree with everything Tyler said, and it's been similar to our experience as well. We were fortunate enough that coming out of COVID, we were pretty active in a lot of the public names that own senior housing. So I think that gave us a little bit of an entree in terms of what we were seeing on the fundamental side. We got to know a lot of the managers pretty well. And, you know, I mean, you're basically talking about running a hotel with a healthcare system attached to it in many cases, right? And so I think we take incredibly seriously the responsibility that we have to the occupants. You know, you're dealing with them at a very sensitive part of their lives and offering them an essential service. So not only is it complex operationally, but there's a lot of PR risk potentially. So what we did is we basically went in, and prior to buying any significant amount of assets in probably 2023, we said, here's the 3 or 4 operators we're comfortable working with, and here are the 2 or 3 management companies that we think can do a really great job, and here's how we're going to approach it. And today, I mean, Tyler, I'm sure has seen this, you know, you look at what buying one of these, the first thing you do is, who's the GM? Who's your senior sales team? How do you make sure that all the, you know, all the registrations are done the right way, all the licensing is done the right way, and the onboarding takes 6 months. I mean, it's a really complicated thing. So I think we do it with a lot of humility. Obviously, it's going the right direction so far, but it's not for the faint of heart.
Great. Now I want to switch gears again and talk about data centers, which is a nice segue into our next panel. So Tyler, you made a direct bet with Powerhouse in Charlotte, and Nick, Baupost has been active in digital infrastructure. So for both of you, given the sheer scale of capital that these assets require, how do you think about sizing that exposure within an opportunistic fund or pool of capital? And then also, what does exit liquidity actually look like in an asset class that's evolving so quickly?
So backing up a little bit, when I was at Blackstone and we were studying how to get into the space, the first deals we did, we bought a series of powered shells from a company called COPT. And a powered shell, essentially when it's completed, is a turnkey, fully built out data center. But the shell itself that you have exposure to as an investor is really just the core infrastructure, the four walls. It looks like a warehouse. All of the mechanical cooling equipment on the inside is the tenant's responsibility. And that felt to us, as we were treading into the space, an easier way to invest in the data center business where we didn't have to really debate the obsolescence of a lot of that interior equipment. And we did that, and we ultimately took private a company called QTS, which was a full turnkey data center developer. And so learned the business to some extent at Blackstone. When I got to Town Lane, I realized pretty quickly, unless I wanted to invest the entire fund in a single data center, I don't think we were going to be building turnkey data centers. And I also went back to sort of the lessons from the early powered shell deals, which was that to me it seemed like very mispriced risk. A traditional turnkey data center today, maybe the cost of construction is about 15 million a megawatt. Your basis in the shell might be as low as 4.5 million a megawatt. So you go 10 million a megawatt of subordinate capital from the tenant, excluding the chips that's invested behind you. Any obsolescence risk, I think, sits at that portion of the stack. Number one, it was highly self-serving since we couldn't build a turnkey data center. We didn't have the capital to do it or candidly the capabilities, but we had an opportunity to come into a piece of land that had been entitled, where they had secured 300 megawatts of uninterruptible power from Duke Energy, and we could come in at the developer's land basis. They didn't have a tenant identified yet, and build a powered shell. And we were adamant that we were very comfortable building a shell. It would still be the largest and will be one of the largest equity checks we write in our fund. It might be, as much as 20% of our fund, but we weren't going to go vertical until we had a AAA hyperscale tenant identified. We had power secured, we had entitlements secured. And because we were coming in at a land basis that was pre those entitlements and that power security, which you can't really find those today anymore, we felt pretty good about our downside risk and the upside. And so we're building a powered shell. We're finalizing a lease, hopefully in the next 30, 45 days. It'll be a large project. It'll probably be $1 billion total build. We can finance it pretty efficiently because we'll have a 15-year fully credit hyperscale lease in hand with interesting bumps. And we're giving up a little bit of yield on cost, not building a full turnkey, but I think I have a lot more back-end liquidity in return because it's really an energized warehouse. I think there's a lot of uncertainty around where the true liquidity is for turnkey data centers. At some real estate conferences, people will throw things at you when you say that. But I think there's a lot of uncertainty, and I think there's uncertainty even in liquidity for a shell. But if you look, in the last, 2 years, I can point to 15 data points of shell deals and where they price, and there's just a smaller number of data points for turnkey. So that was our way of trying to manage those risks.
And what is the market landscape to do more of the deals like this? Like, I don't know if you even have the size in the current fund, but in the next fund, do you see it as one deal a fund?
Yeah, it's a great question. There's an opportunity that we're looking at right now that's another powered land site, and it would be very difficult for us to do it in our first fund. So we're trying to figure out if that's an opportunity that we could capitalize in a second fund, but timing may not work. So that's a big challenge. I mean, we didn't set out to sort of raise the largest pool of capital on the planet. That was my old firm. We're a long way away from that today. So we're trying to live within the confines of what we could do. So it's a real challenge.
Yeah, I think you have to differentiate a little bit between, for a lot of these, and Tyler gave a really good layout of sort of the guts, but, you're either basically buying the land, the power, or the credit lease, right, at some point. So when you think about the finished asset, really, for the most part, people are pricing, a AAA hyperscaler credit or something like that. You can think about that just as an investment grade, bond for the most part. we've been most focused in sort of a similar place, which is specifically in real estate on powered land or, bringing power to land. We set up a partnership about 5 years ago, seeing some of the similar things that Tyler hit on, with some folks that really focus specifically on energy, much more so than data centers. And that's been a successful partnership for us. And I think, how long that goes, we'll see. You're seeing a lot of headlines today about incremental pricing for electricity. There's a lot of, political aspects to that I think will be interesting to watch unfold. But, that versus the actual compute power are two different analyses. And nobody really knows exactly how that's going to break out. How much space do you need? How much power do you need in order to actually ask ChatGPT your question, right?
Yeah.
And that's constantly evolving. So I think we approach it with what we can see today and sort of a range of outcomes on where it could go in the future. As I said, we have this partnership on the private real estate side, but I also think we look at it and say, you're just never really going to know. So are we going to lock ourselves into a 5-year deal while we go and build some very large multi-phase data center that requires a 5 cap exit? I think that's pretty unlikely. We happen to be large shareholders in Amazon. That's kind of helpful to help us think through sort of the different sides of the coin on this. And I think, if you sort of think about the different ways that you can play that opportunity, one of the things that's been nice about, being at a multi-strategy firm is we can own the hyperscaler, we can own the, companies that make the cooling products, and we can own the dirt. And we've been doing all of those things, but in different, amounts over the past couple of years. And I expect that to continue.
I would say, though, as a sector, if you're young and you're in the real estate business, last time I checked, there aren't a lot of new secrets in the multifamily business. Like, you can, there's a lot of really good operators in the multifamily business. There's a lot of really good investors. It's a great real estate asset class to sort of compound and create value over a long period of time, but there aren't a lot of new things to learn. And I think what's really interesting about the data center business in general and how it intersects with infrastructure, and we've got a whole panel on this afterwards with people that know a lot more than the two of us that are experts. But I just think it's a fascinating place given how dynamic things are changing, how dynamic and how quickly things are changing. And I think if you were a young person and you were thinking about kind of, I want to be in a hard asset business, I want to invest in the physical world, but I want to do it in a sector that where, one of the guys that worked for me at Blackstone, I think is one of the experts in the space, and he's in his mid-30s, and he taught me the business. And I think it's just interesting how fast it's changing, and it will continue to change. And there's just a lot of dynamism in the space in general, and it has this weird intersection with energy and power and regulation and all the sorts.
Yeah, the infrastructure overlay is super interesting. And obviously we're seeing, that increasingly get melded across real estate. We see it in other components of what we do. It's a huge part of logistics that's probably underappreciated, is my sense. So, we see a lot of cross collaboration within Baupost thinking about that when we're making industrial investments, for example. But I think it's something that people should think actively about.
And it's a nice follow-up. I want to ask you about AI. I'm not going to ask you about the future of AI, where it's going. Maybe we'll leave it to the next panel. But what I would love to understand, and for the audience, is how both of your firms are using AI today or starting to use AI today to be more efficient. And maybe, what insights you might have for the younger generation in the audience who are just at the start of their careers with all these tools at their fingertips.
Sure. I think our strategy over the last year and a half, and it's really helpful to have a team of pretty young, open-minded individuals that are curious about this stuff, is just to create an environment of experimentation. Our view and our strategy has been, we don't necessarily want to build a lot of stuff that could get disrupted in 6 weeks, but our view is experiment, experiment, experiment. However, I don't think it's just about, okay, can we get the processing done quicker? I think if you're just focused on that, you might miss out on the learnings. And I think a lot of our young people on our team, bring this up, that they want to use these tools, but they also want to make sure they're learning at the same time. You can take a contract and you can feed it into ChatGPT and it can tell you some answers, but if you take an extra hour, you can actually understand the concepts as well. So I think this balance between kind of optimizing on the efficiency side, but also making sure you're not losing out on the learnings is really critical. I think it permeates and has the opportunity to permeate all aspects of our business. We're looking and literally have mapped out, like a system engineer, every process that we have across our business from beginning to end, and are trying to figure out how we can utilize AI more thoughtfully. And, my comment to the younger people on our team is that my hope is that, if their days were, it used to be 90% processing and 10% thinking, I hope their days become, 10% processing and 90% thinking. I also think that, it's turning some of the associate and senior associates on our team, 3 of them are here, into absolute superheroes. I mean, their value to me and to our business is higher. And I think that, I think that's interesting to just think about what does that mean in terms of how it impacts, how our organization is staffed and the different roles people are taking. But I think we're, a year and a half into really experimenting in our business, and we see the impacts daily. And I think it's something really important to strategically think about, both in terms of the opportunities and the risks in terms of what you could lose if people aren't learning as they use these tools. So we're trying to balance those.
Yeah, it's absolutely enabling, I think. I mean, we've seen huge dividends, and I kind of view it as a continuation of what we've seen in 15 years of technological advancement at Baupost. I mean, I remember when I joined the firm, my first job as an analyst was just collecting comps and making sure the model was running the right way and things like that. And, today there's a lot, like we just have a lot more of that. And that was, cloud enabled, it was mobile enabled, it was software. So where we used to have, 2-to-1 ratio of analysts to more senior people, now it's almost 1-to-1. But also it means that, for the more junior folks on the team, they're also getting to spend a lot more time, working through the contract alongside somebody and, ultimately picking up a lot more of that work. It also means that we're emphasizing when we're hiring people, folks that have, really great commercial instincts, people that are really good, interpersonally going out there and actually, helping us find great opportunities to invest in and then ultimately shepherding those to fruition. So I think it's been great in that regard. And again, we're similarly experimenting as much as we can and, constantly comparing notes with other firms saying like, what are you doing? What should we be doing? But, there's huge opportunities even in just being able to leverage the huge amounts of information you can go through now, where we would have said before, is this worth a project for 3 days for one person to figure out, industrial loads in Atlanta? Right. Today, like somebody can mess around for 90 minutes and see if there's something there. And so I think it just makes everybody better, and you're going to have to do it to keep up. So
I think the other thing I would say, kind of building on what Nick said, is the single question I got the most when we were trying to start Town Lane was, hey, you're leaving behind Blackstone and this infinite array of resources, and you had some success there, but can you replicate it without all of those resources? And it was a great question. And the truth was there were a lot of resources I was really nervous about leaving behind. I think some of these AI tools help smaller firms compete with bigger firms because the amount that you can process today with these tools is astounding. And if you've got a young cohort that's open-minded about experimenting with Claude and really playing with these tools, you have a whole department in your hand. And so the other thing I think it's done is it's democratized access to data and information. Unless that data sits behind your own firewall and it's not out into the ether, you kind of have to assume as an investor that everybody has access to it. So to Nick's point, what we talk a lot about is what is a remaining differentiator. And I think it's judgment and what we call kind of the human element. And I think it absolutely informs how we think about hiring. It absolutely informs how we think about how do we want to interact with counterparties? How do we want to treat partners? Because I think our hope is that, we don't own the world's largest portfolio of industrial assets or the world's largest portfolio of multifamily assets. Our data set is what's out there in the ether. The good news is that everyone else's data that's out there in the ether is also ours. But that human element, I think, is really, really critical. And I don't think AI necessarily takes that away.
Great. And I want to take a step back now and just talk quickly about how you guys both got into real estate, talk a little bit about the beginning of your careers. So Nick, you're a Georgetown alum. Welcome back to the Hilltop. You studied political economy, and then you went to go work at Vornado before finding your way to Baupost in 2009. So what drew you to real estate originally, and what did your early career path really teach you about how you invest today?
Yeah. As I said earlier, it's great to be back here, and I never expected to be on this stage. I maybe like some people here, had no idea what I was doing when I got to college. I was an English major. I switched my major 2 times. I ended up in political economy because, candidly, that was probably one of the few things I could graduate with the classes I'd taken on time. So I was sort of all over the place. I started out with various internships. Again, probably like many people here, got an internship on Capitol Hill. I poked around on government. Thank goodness I decided not to do that. And ultimately, when I was, I'd always been involved in some of the investing clubs on campus and things like that. That has sort of been a passion. And so when I started thinking more seriously about finance, even as somebody in the college, I started thinking about sort of what the right opportunities would be. And I had a couple of really close friends who actually either had a passion for real estate early on, including somebody that went to ultimately go work with Tyler when he graduated from here. And I had some family that was in real estate. And so I was just sort of, as I was talking to folks, I was thinking, well, everything that I hear is real estate seems like the least boring version of what I can do in the investing world for all the reasons that folks here know. Great interpersonal skills. You meet some really amazing characters out there, and you get to see what you're working on, which is pretty fun. So I was lucky enough to get an internship with Vornado going into my junior summer. Thank goodness I had some wonderful people there take me under their wing. Some of them are also here today. And at the end of the summer, they offered me a job. And who am I to say no going into my senior year? I'm going to, go spend a lot of that time looking for a job, like nothing better than having one before you even start. So I went back full time, and it was just an amazing experience. It was an awesome place to learn the ropes. I wasn't necessarily looking for Baupost when it came along, but they found me, and relative to where I was, it was probably the only thing that I thought that sounds even better than what I'm doing today. And the rest is history 17 years later. So it's been a great run.
Was there like an early experience or a deal that you can remember that you remember today and like shaped how you think about things?
There were many.
Yeah.
There was one that I could cover very briefly. Right when I joined the firm full time, I was actually put on, I was the junior person working on restructuring a defaulted construction loan that we were the subordinate lender in. And it's saying a lot, that term is saying a lot because there were not a lot of busted construction loans in 2006 when I started. It was a couple more years until that happened en masse. And it was just sort of an amazing experience, that early in my career getting to work on, credit, distress, development. And I had a great teacher for it who sort of took me under her wing and, walked me through like, no, this is how the intercreditor works and things like that. And, the poor borrower had no idea what he was doing and had borrowed a lot of money from his family. So that taught me two things. One, probably don't be a developer unless you really know what you're doing, and definitely don't borrow money from your family if you can avoid it. And those things have all been with me ever since. So yeah, that was one of many.
Awesome. And Tyler, can you talk about your experience? You started at UVA, then
Sure.
with Blackstone, and
I graduated high school in 1999. I thought I was like a tech guy. I think I had like taught myself how to write HTML, which is what the first web pages were in. I got to UVA in the engineering school, and I realized pretty quickly I sucked as an engineer. There were people that were a lot smarter than me and a lot better at engineering, and I pretty quickly realized I should do something different. So I switched into the business school. I had some family. My father was in the real estate business, and so my passion in real estate started to reemerge. And thanks in large part to probably a professor who's just about to retire, who's at UVA. As I'm graduating, I grew up in Atlanta. I thought, you know what, let me see if I can, move to New York. I think I applied for 8 investment banking jobs, got an interview at one of them. I kept telling people my GPA is not so bad if you adjusted for the fun I had at UVA, but that Goldman Sachs did not buy that. But there was an older gentleman who had been to UVA who was recruiting into the Global Industrials Group at Merrill Lynch, and I joined their group. And halfway through the summer, he said, you're working pretty hard, but you don't really seem that into it. I said, I don't have a problem working hard, but I'm not that into Global Industries Group. I said, everyone else got to pick their top 3 choices of which group they want to go into. And I no offense, but Global Industries, whatever that was, wasn't one of my top 3. And he said, well, what do you want to do? And I said, well, if I'm going to work this hard, I'd love to be in the real estate group. And so I think I was the only person in my class who actually transferred groups. And I turned out I didn't mind working that hard as long as it was sort of a sector that I was interested in learning. And a year into Merrill Lynch, getting your butt kicked up and down, a friend of mine that I was out with, who was at Blackstone, tells me this story. He says, this kid that we hired from Texas went home for Easter break and didn't come back. And I said, should that scare me or intrigue me? And he said, well, we need a new analyst. And at the time in the real estate group in New York, there were 2 analysts, and so they'd lost one of them. And I said, can I send you my resume? And next thing I know, I get a job there, and which is another lesson, which is that, you always think it's like the head of the group that does the hiring. The head of the group has no idea who's getting hired at 23, 24. It's the 27-year-olds that are generally hiring the 22-year-olds. And so I started at Blackstone in 2004, and I showed up, and I had never really underwritten a single real estate deal. But what I had done is I'd ripped apart for a year all these public REITs, and John Gray was probably 31, and it was 2004, and he was starting to look at public real estate companies, and he realized pretty quickly, he was like, all right, this kid over here doesn't know up from down about an Argus model, but he understands at least how to read a 10K, a 10Q, and a supplemental. And so from 2004 till 2007, I was like the bag boy working when we took private Wyndham, Car America, La Quinta, Trizec, and EOP. And at some point in that time period, John said to me, you know, when are you going to go back to Atlanta? And I said, I don't think I want to go back. I said, this is pretty fun. And I ended up staying at Blackstone for 19 years. And he was a great mentor to me during that time period and got to work on a lot of really interesting deals. And after 19 years, I finally said, you know, let me go try this on my own.
And was there a moment or a deal or something that made you say, I need to do this on my own?
Great question. I think that God, there were so many great moments and deals and experiences, you know, at Blackstone. I don't think this was the deal that necessarily made me think that I could do it on my own, but it was definitely a confidence boost for me early in my career. It was probably 2011, and I was a young, I don't know, maybe like a young MD or something like that. And an old banking boss of mine at Merrill Lynch called me up and he said, I've got a deal for you. And he said, a core wants to sell Motel 6. And I said, geez, that seems like an uphill putt, you know, trying to convince people to buy Motel 6. And but we went through the math, and I basically was like, wait, we can finance this business and generate a 20% current cash ROE. I took the capital assumption that they'd been running over the last, you know, prior 5 years, and I think we increased it by another 50%. And then we got a capital light franchise business that was attached to it for free. And we could buy it at 8 times EBITDA and sell it at 8 times EBITDA. And at the time, a lot of the other partners were like, you're nuts. You know, that's the craziest idea I've ever heard. Like, why would you want to buy Motel 6? And I said, you got to look at the underwriting. Like, I'm not saying this is someplace you all want to go vacation at, but this is cheap. And I think for me, it was a lesson in a number of things. One, it was it took some convincing. I mean, it was not like I felt like I was out on a limb. I mean, I kind of felt like you buy Motel 6 and it doesn't work out. Like, you know, that's not good. And but I convinced the one person that mattered, which was John Gray at the time, and we did the deal. I think we did the deal despite some objection from others. And he made me a partner the following year, and we ended up making a lot of money on the deal. And I think for me, it was an early reminder of, you know, and I tell the junior people on our team this all the time, you got to have a point of view, you got to have conviction. It can't be the point of view that everybody else has. And you're either going to be right or you're going to be wrong. But I think that was an early boost to my confidence and the sense that, you know, you can analyze something and be thoughtful, and you don't have to go with the consensus or solve for what others think is interesting. You can have a point of view. And I would give John a lot of credit. I felt like numerous times in my career, when I had a point of view, even if it was uncomfortable, if it was grounded in a good analytical argument and well thought through and diligenced, that was rewarded. And I think there was confidence that, you know, that built from that. It took me 12 years after that to leave. So there wasn't that much confidence in 2011, but.
Awesome. Thank you both. So I do want to leave some time for questions from the audience, but before we do that, to cover some of the sectors that we didn't touch on, I thought we'd do a quick lightning round where I'll ask both of you a question and you kind of have one of two answers to respond with. Does that work? Okay.
It better.
We'll see. We'll see how it goes. So the 10-year treasury right now, opportunity or obstacle?
Obstacle.
Obstacle.
Private credit in commercial real estate, threat or gift for the industry?
Gift.
Gift.
I'm going first.
So thinking about industrial, energy cost volatility and how that affects demand today.
Cost value.
Current like volatility. Will that long-term affect demand?
I'm going to say positive, because macro uncertainty will bring stuff back to the U.S.
Negative.
See, switch it up.
Sunbelt multifamily supply, is it absorbing or is it still oversupplied? Tyler?
Shockingly still oversupplied, taking longer to recover.
Ditto.
Retail, is the retail tenant today weaker or stronger than they were 5 years ago?
Stronger.
AI's impact on office demand, is it overhyped or underestimated?
I'm going to say based on public valuations of office REITs, overhyped.
I hate to say ditto, but I gotta say ditto.
Data center power constraints, are they solvable or are they structural?
Absolutely structural.
Structural for far longer than they should be.
Capital raising, LP appetite for real estate in 2026. Is it reopening or are LPs still cautious?
Reopening.
Reopening.
I think still cautious.
Next 12 months in commercial real estate, are you playing offense or defense?
Offense.
Offense.
And this can be an open-ended question. So for the audience, for the students, what's the best trait for a young real estate investor today?
I think intellectual curiosity, like a genuine sense of like, you really want to learn. You're not just trying to do the assignment and move on to the next one, but you really want to learn it and you really care.
That would be my number one. My second one would be just a real sort of like focus on the details as well. Like I think there's a huge amount of conversations I have where people sort of, everybody says the same 70% about a topic, but what stands out to me always and what, wins the day in a lot of the conversations is the 2 or 3 nuggets that nobody else knew. And I just think in an increasingly competitive world, that's critical.
Awesome. Well, thank you guys. Thanks for your insights. Appreciate it.
All right, just to ask one question from the audience, because it's a good one, and as a dad myself, so you both had fathers that were prominent in the institutional real estate business. What are the most memorable things they taught you about the industry?
I can answer that pretty quickly. I don't think it was anything about real estate. I think it was about balance and making sure that you are very thoughtful and cognizant about the trade-offs you're making when you're deciding what to do with your career and who you work for. I think far too often people run into this business or their careers overall and just think about it one-dimensionally based on, just it being a job and not how it fits into their overall life. And unequivocally, the lesson I saw from my father was he made very conscious decisions to balance other priorities in his life. He could have grown his business bigger. He could have done a lot of things, but he raised 6 kids. He spent a lot of time with us. And I think that's absolutely the biggest lesson that he taught me. And we hardly, if ever, talked about cap rates. Thankfully.
Well said. Yeah, he was dad first. And I think he actually would have been thrilled if I hadn't gone into real estate because he'd lived it for a long time at that point and knew all the terrible things. I think in many ways it was sort of as a cousin to what Tyler just said, also knowing that you got to do something else at some point in your life. And, this doesn't go on forever, but you can also have a wonderful career and there's a lot of other things that you get to do. And, if you have a bad cycle, if you have, a bad role at some job, there's other things you can do as well. And there's other chapters to that. Life is long. So just that long-term perspective has made a huge difference.
There's one quote that my dad has. I think it's a great quote. He started his career as a leasing agent for Hines. And he was a really good leasing agent, but they used to make fun of the bad leasing agents. And they would say, he or she has good book. And the line was like, they had a fancy flyer or good deck or good book, but they had no idea how to sell and close a deal. And I like that line because I think sometimes people think the job is having good book. And in your early part of your career, you got to get the numbers right. You got to get the analysis right, like absolutely. But I think that's all to graduate to really then be in the game, which has nothing to do with good book.
Amazing. Can you join me in thanking these folks here?